everybody. Welcome to the No Shill Zone. It's that special time. It's Monday, 11 a.m. I'm joined by Ben Cowen. We are here to give you guys the data on the markets, and we have some crazy stuff. Let's start right in with crypto because we've seen some big moves, right? We've seen Bitcoin pushing up. We've taken out that fake news high from last week. We're approaching some key levels. What are you seeing in the market, Ben?
Yeah, I mean, it's an interesting market. Bitcoin has sort of come back up here to these prior range highs. So I suppose that is some resistance that it's going to have to face if it wants to push higher. But what's fascinating to me is sort of the disconnect between what's going on in the S&P and what's going on with crypto. We saw the S&P, close below the 200-day SMA last Friday as the long end of the yield curve has gone up. But at this point, crypto seems to have shrugged it off. The question is who's wrong, right? Who's wrong? Like, is it the stock market that it has been too bearish? Was it just a seasonal correction? Or is crypto offsides and Bitcoin going to fall from these levels? What are you looking at with Bitcoin here?
Yeah, so I think for me this is a level that I even talked about last week, and I'll show my screen. In my service, Verified Investing Crypto, we went long Bitcoin a couple weeks ago on the break point here. And let me show my screen here. So once we got above this down sloping trend line and then kind of retraced a little bit, we jumped on the long side because, again, this was a decent short-term breakout with a target. Really, my target's right around 31. We're really approaching the target now. So I'm actually getting ready. If we pop above between kind of 31 and 32, I'll take half off the table on that trade and kind of pocket it. But for me, this is getting a little long in the tooth. I think this is where a real trader kind of stands out in that, my long-term view, and we're talking years out, is insanely bullish on Bitcoin. My short-term view, meaning the next 1 week or over the last week, has been bullish, but my midterm is still kind of gray. And what I mean by that is that I'm not convinced that this is all of a sudden the new bull market. And I think as a trader, you can be long and be short and still be kind of concerned about that midterm in what we're seeing. But clearly, it's been a great move. We've seen alts catch fire. One of the charts that we were looking at last week was this Cardano chart. Had a little wedge pattern. We've broken above there. So we're trying, but I think you have to just go back to Bitcoin is still king of the hill, right? I mean, even with these moves, we're generally seeing Bitcoin stronger. That's because institutional money is not going to Cardano right now. I mean, let's be honest. It's wanting Bitcoin because of the spot ETF. And I think part of it too is the move on Bitcoin last week or whenever that fake news hit. It showed what's going to likely happen when we see that approval. So I think what's actually going on now is the move is people essentially jumping in on expectations of the approval. And I could actually see us wick up. We could have this big pop on the approval, and we could actually see a reversal following that, in my opinion. So it's a fun market. I mean, this is a trader's market. I was saying that to you just before we went live. This is my bread and butter type of market where we get these bigger moves. When Bitcoin was doing nothing, it kind of sucked as a trader. I'm like just sitting there with nothing to do. This is where there's opportunities. So.
Yeah, I was curious because we were talking a little bit about this earlier, and with regards to the spot ETF narratives that are obviously being talked about right now. If you look at the GBTC chart, you can see that it's actually already taken out these highs from the summer. And if you go look actually at the premium on GBTC, it's down to only about -7%. Mm-hmm. So I wonder if this buying pressure from GBTC on a lot of institutional investors sort of banking on this conversion to a spot ETF, that could be where some of that strength is coming from. I think some of the other strength is coming just simply, and we've talked about this before, just that bleed from the altcoin market back into Bitcoin. You said it yourself. I mean, this move, while everything or a lot of these things have been going up, Bitcoin seems to be the stronger place still. And I mean, again, the Bitcoin dominance just keeps putting in new weekly yearly highs. This is the 10th green week in a row.
Yeah.
I think I think maybe 2 months ago, we talked about the dollar and how the dollar had just been it moved up 11 straight weeks in a row. And if that's sort of a measure of liquidity getting sucked out, then perhaps the dominance of Bitcoin would also make a similar move. And at this point, it really has. Right now, it's in its 10th green week in a row as that liquidity just flows back to the king.
Yeah, absolutely here. So I think that's really important to kind of take note of. And I think overall, what you have to recognize is that Bitcoin dominance probably does continue up. But I do have, and I think we talked about this. There's a trend line that I have at around 53.5% on dominance. And that's kind of where I'm expecting it to go in the near term. And then I think you could see it kind of stall out. So it'll be interesting to see if does that occur? Does that get hit on the approval? Like, will we see approval soon and will that get hit? Or does it hit and then pull back and then we get an approval? But I think either way, I think you and I both agree that at some point the spot ETF's getting approved. And I think the market is factoring that in at this point in Bitcoin's price.
Yeah, and I think one other way to potentially look at the dominance, just one last thing to look at with it, and we can move on, is this is the Bitcoin dominance. This is an approximation of Bitcoin dominance on TradingView, but excluding stable coins, right? So the other one includes stables, this one is excluding it. And it seems like it's, sort of in this wedge pattern, right, where it's sort of slowly trending up. And I mean, on this move here, right, it's currently at 58%, between 58 to 59%. Just coming back up to the top of this range would put it at around 62% or so. So I still do remain bullish on I'm basically bullish on Bitcoin dominance for two reasons. First of all, it normally goes up in pre-halving years. That's typically what we see. But the second reason is we are still in a tightening cycle. And the thing that I go back to is, outside of seasonality, outside of all of that, I look back at prior cycles and I say, well, last cycle, the dominance only topped after the Fed started cutting rates, right?
Yeah.
And so, while there could be short-term pullbacks, we've seen plenty of short-term pullbacks this year for Bitcoin dominance, but I still remain bullish on it because I do think that it will continue higher until we get back to looser monetary policy.
Yeah, I agree with that. And by the way, I'm just seeing Johan saying bear show, and I'm like, dude, is he watching the same show as me? Because I could have sworn I said I was long Bitcoin and long Cardano and long Polkadot. I didn't even mention Polkadot, but it's just like, man, dude, are you watching the same show as we're doing? Or maybe I'm just saying things that I'm not aware of. But
what do you? I know. Last week you were pretty optimistic about some of the altcoins, and I think you were looking at some turnaround plays. What are some of the ones that you've been focusing on the most recently?
Yeah, so I think the key is that this is just short term, right? So I happen to be in your camp that I'm not convinced this is over yet. But when you see something that's kind of coiling like it is, when you have this kind of sideways chop and you're trading at the low end of a range, essentially what we've seen is the psychology of alts, and it's almost like a rubber band, right? The psychology was getting pulled in the bearish direction, where it's just people were just being beaten down on alts. And at some point, there has to be that kind of snapback effect. And it's just a short-term snapback effect, but it kind of creates the scenario for like a short-term little breakout on Cardano. So I could see a Cardano trading to like 30 cents and then rolling over and potentially coming back down and actually eventually even breaking lower. But I think there's this just rubber band effect. And the same thing with Matic. I mean, Matic was another one where we could see it just hugging this line. Now, eventually this line probably gets broken through to the downside, but in the short term, it gives us a little bit of a setup here for a move to the upside. And again, in terms of a target, on Matic, it kind of touched, there's a little bit of resistance around 65 cents. Maybe it trades a little higher. One of the levels I'll show you guys on Matic where I would definitely be looking to sell. And by the way, I don't have any Matic right now. I got myself into Ripple. I have Ripple, Polkadot, Cardano, and Bitcoin right now. Those are, and Litecoin too. But basically, if you look past, right, see all this little pivot low area here. If Matic were to get to 72 cents, that would be a huge level for me where I'd start to say, okay, maybe a retrace or a pullback would come in. But yeah, I mean, to me, this is my trading mentality. It's kind of like, a trader is looking at the next 1 to 2 weeks. That's really all a trader cares about as a swing trader. And more of an investor is obviously more 6, 12, 18, 24 months out. Where I think most of you guys out there are at. But yeah, I mean, it's been a nice little move. For me, it's about, and this is getting into psychology of a trader, is there when you're in positions that you're deep in the money, like if you guys remember what I just said on Bitcoin, it's like, so if we hit my target of 30, we're very close to 31, right? So 31 to 32, I take half off the table. And the reason I do that is that as a trader, you don't go in expecting to hit a home run. Home runs can happen where you just wake up one morning and holy cow, look at that move. But in general, I've lost more money trying to hit home runs than not. So I've become very much a methodical trader. It goes up X to my target. I take half off, which is pocketing those profits. I let the other half run. all right, with maybe a break-even stop on that position. If it keeps going, awesome. If it pulls back, because I unloaded half the position, I can re-enter at a key level, dollar cost averaging, right? And again, that's the mentality of a trader more than anything. So it's fun stuff. Now, if we can turn, I don't know if you have anything else on crypto, but I'd love to turn our attention to the yield.
Maybe just one more thing very
Yep.
quickly, and then I'd like to look at some of the macro stuff, and including yields. But this is a chart we've been following here for a little while. This is that year-to-date ROI for Bitcoin compared to the average of the last two pre-halving years, and this sort of corresponded to around a similar pump. But what I'd like to also look at beyond Bitcoin is just look at it for ADA, Cardano. So this is what one of the ones you were following. We saw a similar pump back in 2019 on ADA. And it still trended up for a little bit longer at this point, but it still eventually faded in that November and December timeframe. Same thing with Ethereum, right? I mean, it got a little bit of a bounce around the same time in the pre-halving year of 2019, and then it still faded in November and December. And one of the things that I was sort of thinking about is, if you go look at where Bitcoin's rally topped out in 2019 after the death cross, right? So we had a death cross and we had a rally. It actually topped out this week, right? So it was the week of October. I think it was like October 22nd, I believe. Yeah, the week of October 21st, right? You had a massive move by Bitcoin, and then it ended up topping out and then rolling over. And I've been wondering, like, well, if it does, I mean, again, there's no guarantee, right? But if it does roll over, what would be the narrative in November that would sort of cause that? And I think one thing that I've been looking at is of course the labor market. And if you look at continuing claims, one thing that you'll notice is that it's starting to go back up, right? It bottomed out last year in September, and now it looks like it's potentially bottoming out here in September as well. And the issue here is if you look at, say, a month-over-month percentage change, right? And we sort of look at what's going on here. This is, I mean, the month-over-month percentage change at this point is at like 4.5%. I mean, it hasn't been this high since March of 2023. And you can see that, it actually went much higher back in late 2022. So I do think, if in November there's like an unemployment rate print of like 4% or something, that could be something that finally makes crypto pay attention.
Yeah, I agree. And I do partially wonder if, I mean, you look at, like, if I show my chart here and we look at the move on gold recently, I also wonder if there's a little bit bleeding over into Bitcoin. I mean, this was such a tremendous move on gold recently. And I do view Bitcoin as like the future digital gold. Even though I don't think it's quite there yet, when you get such a dramatic move in gold, I do think there's a bleed over effect. Even like we saw, by the way, this was argued in 2021 if money was being pulled away from gold towards Bitcoin at that point. So I think it goes both ways, where gold can help Bitcoin at this point as well as obviously hurt it. But yeah, so just one thing I want to touch on here as we continue to rock it in this no shill zone is that this morning I talked about this headline: more people are missing car payments, in another ominous sign for the economy. And I think as much as the jobs numbers have held up, this is just more alarming underbelly stuff. The rate hit 6.11% in September, per figures with Fitch Rating reported by Bloomberg. Vehicle repossession rates are also on the rise. But essentially, we're at levels now of defaults or people not paying their car payments that have not been seen since 1994, which to me I found alarming because, first thing I'm like, oh, well, this probably happened in 08, 09, right? I mean, that was a horrendous period, but we're now at levels above that. And I think that just goes to me to say, okay, even though the jobs numbers have been resilient, we probably are at a point where there is cracks emerging. And then to that point, not to make this too long, but this morning yields were up above 5% on the 10-year, right? And then we saw the markets getting crushed again. The stock market was getting crushed. Bitcoin was doing its thing. It's kind of been ignoring this. But all of a sudden, Bill Ackman tweeted, "We covered our bonds short. There is too much risk in the world to remain short bonds at current long-term rates. The economy is slowing faster than data suggests." And literally, I kid you not, guys, go to the 10-year yield. The 10-year yield collapsed on that thing. Look at this drop. This is when that hit, and the yield went. It had already pulled back from 5%, but we just went to 4.86%. 7, 8 right now on the 10-year. And you know what the S&P did? Take a look. S&P opened lower and is now turned green on the day. So just really like this is stuff that's happening real time with the markets. But Ben, I'd love your take on like rates, like what's going on here.
Well, I mean, I think the long end of the yield curve finally started thinking that the Fed was serious about higher for longer. I mean, I think that was a huge component of it back in the summer. So coming into this year, I thought that I was going to turn bullish bonds by the summer. But by the summer, the 10-year was still at 4%. The 30-year, you know, they were still at 4%. And I thought there was sufficient reason to think that, let me just pull it up here. Right? But I thought there was reason to think that, you know, the 10-year could actually break out of this pattern, you know, of this prior high here. And that would lead to that seasonal correction in the S&P. Like we talked about a seasonal correction by the S&P and in that August to September timeframe. And you know, I think I suggested, or I said that we would likely have a period where both stocks and bonds go down. But now that period has potentially come and gone. And I think we are maybe entering into a new period where, and again, I'm not saying necessarily that the lows for bonds are in. Like there's a chance that the long end of the yield curve could go to where the short end is at like 5.5% or something. But I also think that relative to equities, bonds are starting to become more attractive. Right. You know, just relative to equities. I mean, this is what, 3 years in a row where bonds have been sold off, the worst bear market in bond history, I believe. And so I have to wonder how much more can the economy take, you know, and so my view is that, you know, because if we go back and look at the yield curve and what's been going on with the yield curve, and we've been seeing a steepener, right? But it has not been a bull steepener. It's been a bear steepener where the long end of the yield curve has been going up. It looks a little bit more pronounced on the 2-year, the spread on the 2-year and 10-year yield. You can see it's not even that far away from uninversion, but this is due to a bear steepener. And I think some people are saying, well, that means this time is different. But I also think there's a case to be made that if the long end is going up as much as it has, then a lot of companies are going to have to start accounting for this and potentially having to cut costs because the cost of capital is a lot more expensive than it used to be. And then that could lead to those layoffs, and that could lead to the short end finally going down on rate cuts. But at the current time, you know, I think that bonds are starting to get, you know, attractive relative to equities.
Yeah, and I agree with that. I think, you know, people always ask me like the understanding of why when rates go up, does the stock market generally want to sell off? And because you're basically getting an alternative, guys. So remember that when you're offered, like if I said to you, you know, I will give you a 50% guaranteed return, or you can go invest in crypto or stocks. I mean, at that interest rate, what's your decision going to be? I know mine would be like, dude, 50% return. Hell yeah. You know, why would I take any risk of losing? And so you have to understand is as rates creep from 1%, like at 1%, no one was, well, I shouldn't say no one, but very few people were saying, oh, let me not invest in stocks because 1% sounds so great. But once you get to 5%, now people are like, you know, there's risk of a recession here. The debt is this. Maybe 5% seems reasonable. And that's where the market, like that's where investors will take money and switch it over. And that's, again, why you have that inverse relationship with stocks usually, as well as with bonds or with yields, I should say.
Yeah. What are your views here on the S&P 500? Because there were, I mean, with the rates going, where rates dropping today, we can see the S&P 500 is at least up in the short term. And I know that was what you were expecting, and it seems like it's playing out. But I'm curious, what is your midterm view on stocks? Because we just saw the S&P close below the 200-day SMA on Friday. And we also saw the Russell, I believe, go to valuations it hasn't seen since October of 2022. So, I mean, it seems like there's some warning signs popping off here.
Yeah, there are. I mean, there's so many warning signs, whether it's in the data or in my opinion, what we're seeing in yields. You know, between what even like, I don't know if you heard some of the comments from Jamie Dimon just recently, even Warren Buffett and Charlie Munger. There's things that I think as an investor, you have to pay attention to and really be on alert for. It doesn't necessarily mean it's going to happen in the short term, right? I mean, you know, both you and I think, thought that yields would reach a level where they would reverse a lot sooner than they did. To me, this has kept on longer. But it just shows you eventually it does come to fruition. To me, at least, it does.
I mean, so my view for the last year was that TLT would likely go down to 80 to 85. And now that we're there, I'm like, there's that's one of the reasons why I've sort of flipped my views and I've become more bullish bonds. I'm just my main thinking is like, how much more can the economy sustain? I mean, if you look at like the Atlanta Fed, I mean, I think they're predicting what GDP Q3 annualized to be like 5% or something.
Yeah, I saw that number and I did a double take. I'm like, wait a minute, what?
Right. So I think the question is like, how much more of this can the economy take? Can the economy survive longer, even at 5.5% for the long end? I don't know. But I do think, relatively speaking, bonds are starting to become more attractive than equities. And by the way, I mean, if you look at equities, we did get that correction over the last couple of months that we previously discussed. But at this point, I think one thing that we kind of always have to go back to is that so far we are still at historical norms for the S&P 500, right? Like if you average out prior pre-election years, this is slightly lower than where we normally are. So what I would be looking at over the next couple of months is, does this hold, or does it become more than a seasonal correction? And Gareth, I think if it does become more than a seasonal correction, then the bond market going up, right, or the long end going down could actually turn into something that's bad for stocks, right? Like right now, today, it has been good for stocks, right? But if it continues to go on for for weeks, it could turn into something that's bad for stocks.
And then that's what people have to understand is that I just see the headlines now on Twitter is like Gareth said when yields go up and when yields go down, that's really good for the market. But yeah, right now it is, right. So you have to understand this is right now. Markets are so concerned about higher rates that they want yields to come down. That means risk on, but there will be a pivot point where all of a sudden collapsing yields causes as much panic in the stock market as rising yields.
Right. Yeah. And who knows when that's exactly going to play out. But by the way, I'm curious, could we maybe look at some of these commodities, because we talked a little bit about them before. What's your view on oil right now? Because I think that continues to be a potential risk due to inflation, of course, if it continues to stay at elevated levels. Are you thinking that that oil is going to sell off into a recession, or do you think it's going to keep climbing the wall of worry until it pulls recession risk forward?
Yeah, so I'm actually in the case that oil has put in a top here. So when we hit this 93, 94, 95 area and we saw this corrective move, I think that was the top that we're going to see in this cycle. I could definitely be wrong. That's always a possibility. But this bounce has come. So oil has bounced while we've seen the Israel-Hamas conflict come in, and we've seen the worries about Iran getting drawn in and all these other countries. And the bounce didn't even take out this high. Now, right there, that tells me something, right? And to me, the macro picture is much, much bigger here of importance, which is a slowing U.S. economy going into recession, which is what smart oil traders are probably realizing. And that's why you're seeing. So think about this, the small investor, the retail crowd, the kind of the dumb money, even institutional money can be dumb money, by the way. It's only an elite group at the top that's really considered the smart money. They're all buying on the, oh my goodness, the Middle East could erupt in war. The big money is selling into that. The smart money is dumping into it. That's why you're not seeing new highs. In addition, keep in mind, you do have a potential pattern here, a head and shoulders forming, right? So if we look at this and we go up here, down to here, here, and then we bring it right down in here, this is a potential head and shoulders. So if we break the neckline at like $84 or so, you could actually have a measured move down to about 73. So I am bearish on oil here. I'm not short at this time, but if we got any sort of little uptick in it into the 90s, I would be looking to short it.
Yeah, I mean, do you remember like what a few months ago we were both very bullish on oil, and we were watching it go higher, and we're like, there hasn't really been a whole lot of news, but it just keeps going up, and it seemed like it had legs. But it's almost like once the conflicts, the geopolitical stuff actually came to fruition, that is potentially marking a turning point. And it's interesting that it hasn't gone up despite all of that too. It could start to show that there's perhaps a slightly weaker consumer.
Yes.
Right now.
Yes, I think that's a big part of it too. And I think this is something that's overlooked, but the U.S. now basically generates enough oil to make us independent of the Middle East, almost, right? And so it's not the same impact. Like 20, 30 years ago, things like this going on in the Middle East, you would have seen $150 oil. Now it's not the same because the U.S. has such a huge amount of production to it. So just kind of keep it in perspective in that side.
Right. Well, should we wrap it up with maybe talking about there? I mean, I did want to at least get your opinion on silver, because gold seems to have been doing a lot better than silver recently. And I know you were more bullish gold than silver when I spoke to you about it a few weeks ago. Are you still in that camp?
Yeah, so I did call for a little pullback off this resistance level right up here. We had a beautiful level at 1985. So you've seen a little bit of a pullback, but this to me is a bullish breakout of this channel, this downsloping channel. So any sort of pullbacks would be buying opportunities. And I honestly will say that I'm in the camp that I see kind of a test of this 2080 level, which is that triple top, probably by year end. I mean, certainly if we have another move like this, it could easily occur by year end or even sooner. And again, I think it just comes down to the more instability globally, the more debt the U.S. government is going to take on, which honestly shows no signs of abating. The more, all of these issues come to fruition, I don't see what's the bear case. How does gold come in? Like, what would have to happen for gold to actually come back down? So I don't know your thoughts, if you have any interesting insights on gold, but I'd love to hear them.
Well, I think this is actually the silver chart. I think one of the things if you look at sort of how gold performs going into a recession, it can sometimes sell off, and maybe that's the sell off that we just saw. I don't know, but when QE comes back, after that, that's normally when gold really takes off. So there could be a case to be made that it's just sort of building up here until QE returns, and then it'll be set to explode to the upside. I'm pretty bullish gold over the next 5 to 7, basically for the rest of this decade. I think I'm fairly bullish gold, just because I think we're going into a period where harder assets like precious metals are going to perform better. I mean, I think for the last 10, 15 years, they've just kind of been the laughing stock, right? But I mean, everything is cyclical, and I think we are going to be I think we're entering in that window where some of these harder assets will start to outperform.
I agree. And I saw a question there about when 12K. I'm assuming you're referring to Bitcoin. I would just say this is it's not off the table yet, and don't get swayed by emotion. It's that would be aligning with what I would say would be my worst case scenario if the global economy starts to tank and we see the NASDAQ drop the equivalent of an 08, 09, then I still think 10K is even a possibility on Bitcoin, just due to sheer panic. But that would just be a worst case scenario. I still would not be surprised, though, if in this cycle we retest 20,000 at some point in that maneuver. I also saw another question, just to address a couple questions. And again, I just think if we have a couple minutes here, someone asked me, or I saw someone say something about, they haven't mentioned Chainlink. I'll mention Chainlink here. It's a short. I shorted it. So I don't know if that was the answer you were going to look for, but I pulled the trigger on a short on Chainlink. 3-bar surge, got my last piece of the short off close to these highs last night. And I'm looking for a pullback. Again, this is a swing trade. So it's just looking for 10, 20% pullback on it. And we'll keep an eye on that. And I don't know if there's anything else you saw out there, Ben, in any of the questions that people were asking about.
Well, I can't even see them right now. But the last thing I was thinking about was, and I think we talked a little bit about how crypto tends to move a bit more discreetly than the stock market.
Yep.
And so the candles here are Bitcoin, and then the orange line is the S&P. And so you can see that the last time that Bitcoin was at this 23K level was back when the S&P was at that 4,100 level. So, as I've said before, we normally get a secondary scare by Bitcoin, not caused by crypto specific things. It's more so caused by the S&P dropping, macro related things. And so I think, for people that are wondering, what could take Bitcoin back down to those lower levels, certainly on days like today, that's not going to be a popular view. And I can understand that. But I think the risk is not crypto specific at this point, right? The main crypto risk occurs in the bear market years of 2014, 2018, 2022. The risk of the later on in the pre-halving year and the halving year tends to be what's going on in traditional markets. And so I think if you were to see the S&P fall back down, to where it was in early 2023, that could make Bitcoin sort of break out of this range and sort of go back to some of those levels. So I think that's the bigger risk to look for, not a crypto specific risk, just a more macro risk.
Yeah, 100%. I agree. So, on that note, let's wrap it up. I do want to say this, folks, is that, days like today, Ben and I are going to give you the same information based on the data that we give you on days when crypto is getting crushed. Same thing with the stock market. We're going to give you guys the actual data. So, if you want to live in an echo chamber, there's plenty of places on Twitter to go and hear exactly what you want to hear. But there's a reason why Ben and I have been doing this so successfully for so long, as we follow the data. You can see sometimes I'm bearish and sometimes I'm shorting crypto. Sometimes I'm bullish like I am now and where I'm long crypto. And it's just a matter of what the charts are saying. And I want to thank Ben for his time. He comes out every Monday or sometimes on Tuesdays, and we just do our best to give you guys that non-biased stuff. Remember, below this video, there's there's all his links to his socials, his website, etc. Go follow him. Again, folks, you want to live in an echo chamber, go lose money there. I'm here to help you guys. Ben's here to help you guys.
And I echo the same thing, guys. I mean, Gareth provides a lot of great analysis on the markets, and he also, for the people that follow me that wish I would focus on more of the short term trends, which I'm not normally willing to do. You'll find all of that on Gareth's channel. So he actually looks a lot more at these social or the sort of the lower time frame trends and trying to make money in any environment, right? On shorter time frames. So make sure you go check him out. He provides a lot of that analysis, which you won't find on my channel at all. So again, all links to his socials are down in the description below, and we will see you guys next time.
Have a good one, guys. Take care. Bye-bye.